Welcome back to the Deep Dive.
Today, we are really digging into one of the most interesting stories in Latin American finance.
That's right. We're looking at Grupo Cibest. You probably knew them as Bancolombia. And their Q3 2025 earnings call. It dropped pre-market on November 7th.
And when these results hit the wires, well, the market reaction was immediate. And it was strong.
Oh, absolutely. This wasn't just, a small beat. It was a signal of a real operational shift. The stock rallied almost 7% over just 2 sessions.
Exactly. That doesn't happen by accident.
Oh.
So our mission today is to unpack what's going on under the hood. We're talking structural shifts, some really critical digital milestones, and a capital return strategy that management seems very serious about.
Okay, so let's start with the hard numbers, the headline figures that keep everyone's attention.
Right. So GAAP EPS came in at $2.18 per ADR.
$2.18. And the consensus on the street was what, somewhere around $1.80?
Just about $1.80. So that's a decisive beat. We're talking 21%.
A 21% beat is huge. And that carried through the top line too, right?
It did. Total income hit about $1.96 billion. That's up a solid 20% year over year. So the growth engine is definitely firing.
And all of that flowed straight down to profitability.
It's the compounding effect. Net income for shareholders jumped 42.8%. But the metric that really matters for a bank's valuation...
Return on equity.
Return on equity. It expanded sharply to a quarterly ROE of 20.4%.
20.4. That is a very, very strong number. It puts them in the top tier of their regional peers.
It does. And, the immediate drivers were things like resilient margins and a big drop in provisions, which we'll get to. But to understand if this is sustainable, we have to start with the big structural change they made.
Absolutely. So let's do our first deep dive there. The strategic shift to the Grupo Cibest non-bank holding structure.
Right. This was completed earlier in the year, and management was very clear on the call. This reorganization is what unlocked their new approach to capital.
So explain that a bit. How does changing from a bank to a holding company structure actually help?
Well, think about it. Before, as Bancolombia, everything was under the strict capital rules of the core commercial bank. All the business units, even the high-growth fintech stuff like Nequi, had their capital sort of trapped.
Trapped within that highly regulated entity.
Exactly.
Yeah.
But with a holding company, they separate the core bank from these other non-bank subsidiaries.
And that creates new levers for them to pull.
Powerful new levers. First, you get regulatory arbitrage. The non-bank parts have lighter capital rules, which frees up a ton of capital you can now give back to shareholders. And second, it creates optionality.
Optionality, meaning Nequi could get its own funding or even spin off down the line.
Precisely. They can unlock value there without messing with the core bank's balance sheet.
And we are already seeing that capital being returned. The ongoing share buyback is huge.
It is. COP 1.35 trillion. And this isn't just talk. They're executing. By the end of Q3, they'd already completed about 26.7% of the program.
That's about 7.3 million shares. And it's interesting they're buying back the ADRs, too.
Over 41% of the buybacks were ADRs.
Yeah.
That's management showing the U.S. market they believe in this new valuation story.
And the market is clearly buying it. The ADRs are up a staggering 86% since this holding company idea was announced back in October of 24.
It just changes the whole narrative. It's not just a play on Colombian interest rates anymore.
Right. It's a total shareholder return story now. Which brings us perfectly to our second deep dive, the digital engine.
And this quarter, they dropped a bombshell. A really big one for the entire Latin American digital banking space.
The digital bank, Nequi, achieved positive net income for the month of September.
That is a massive turning point. For years, Nequi was seen as this expensive, necessary investment, a cost center.
Now it's proving it can actually make money.
And management sounded very confident. They're guiding for Nequi to hit its first full quarterly breakeven by Q1 of 2026.
And the usage numbers back that up. The activity ratio is over 80%.
People aren't just downloading the app, they're actually using it. And that activity is being monetized, and monetized aggressively. Fee income at Nequi is up 65%. But the real story is the lending.
Their loan book expanded 2.3 times.
2.3. And here's the kicker. New loans are going out at interest rates near 25%.
25%. That's high-yield territory. So how are they managing the risk there? These are consumers who might not have a traditional credit history.
That's the digital advantage, right? They're not using old-school credit scores. They're using proprietary digital models, behavioral data, from the app itself. They can price that risk much more accurately.
So that high rate lets them absorb the expected defaults and still make a much better risk-adjusted return than, say, a mortgage.
Exactly. It's a very sophisticated, data-driven strategy.
And beyond Nequi, there's also the launch of Broof, the new payment system.
Right, the interoperable system.
Yeah.
And Cibest is just dominating it right out of the gate. They account for 52% of all the digital keys registered.
And here's the part that should really get your attention. Management said they're seeing a net positive cash flow within Brave. More money's coming in than going out.
Which tells you they're winning the first battle for the digital wallet. When people move money, they're choosing to park it in a CIB account, whether it's Nequi or the core bank. Their platform is sticky.
It's a destination for funds. All of this digital strength led to net fee and service income of over 1.1 trillion pesos, up 9.5%. So great revenue diversity.
Okay, let's pivot to deep dive 3. The core bank's performance, margin resilience, and asset quality.
Net interest income, or NII, held up really well at 5.3 trillion pesos. The consolidated net interest margin, NIM, was steady at 6.59%.
Which is impressive. They managed to offset some loan yield compression, from lower rate mortgages, by really pushing down their funding costs. Deposit costs fell 13 basis points.
But the really clever part was what they called their stress-proof strategy for future rate cuts.
Yes. This is just smart treasury management. They're using interest rate swaps to hedge their fixed-rate deposits. 21% are now hedged. And they've shortened the tenors on their time deposits.
So 70% of them mature within a year.
Right. So when the central bank eventually does cut rates, they won't be stuck paying high rates on old deposits. Their funding costs can reprice down much faster. It protects the margin.
That's some serious foresight. Now, what about loan growth? It looked flat on the surface.
Nominally flat. Yeah, 0.1% quarter over quarter. But you have to adjust for the currency. The Colombian peso appreciated 3.6%.
A headwind.
A big one. If you strip that out, underlying loan growth was actually 1.2% for the quarter, or almost 6% year over year. So the core business is still expanding.
But the biggest financial boost, by far, came from asset quality. The cost of risk just collapsed.
It really did. Provision charges were down 24% sequentially and a massive 33% from last year. Cost of risk hit a low of 1.18%.
Okay, so that's a huge improvement. But we need to look at where it came from.
Critically important. Management said it was two things. First, genuinely improving credit trends, which is great. But second, there were some model-driven provision releases, about 266 billion pesos worth.
And provision releases can be one-offs. You're just taking back reserves you'd previously set aside. So how much of this quarter's great number was sustainable?
That is the million-dollar question. And while those releases definitely juiced the EPS number this quarter, management was clear that the underlying trend in consumer and SME credit is genuinely positive, and their NPL coverage is still super robust at almost 110%.
So the 1.18% cost of risk is probably not the new normal, but the overall direction is good.
Exactly. The trend is positive, even if the absolute number normalizes a bit higher.
Which brings us to their guidance and this fascinating disagreement we're seeing among analysts.
Right. For 2026, they're guiding for accelerating loan growth, around 7%. They see NIM drifting just slightly lower to between 6.3 and 6.5%. They're basically admitting we're past the peak for margins.
But the key message is the ROE target, 16 to 17% for 2026.
And that anchors the whole story. They're promising sustained high double-digit returns. They do expect cost of risk to normalize up into the 1.6 to 1.8% range, which confirms that Q3 was exceptional.
And the macro backdrop seems okay. Disinflation, GDP growth forecast at 2.6%. Latin America is attracting capital.
It's a decent backdrop. But here's the friction point. You see this sharp divergence in what analysts think. The momentum guys are all in. IBD composite of 96, super bullish.
And yet you look at the traditional sell side, the big banks.
And the average rating is still a sell, with a price target around $42.
42. It's trading at 63. That's a potential 33% downside. How can there be such a massive disconnect?
Well, the traditional analysts are likely worried about things the company can't control.
Or macro stuff.
Geopolitical noise, currency risk, political instability. They're looking at the history of volatility in the region, and they're discounting future earnings heavily. They're basically saying, great quarter, but we don't believe it's sustainable. The stock has gotten ahead of itself.
So it's a classic battle, betting on a real structural change versus betting on history repeating itself.
And that leads us to our final segment.
This is absolutely not financial advice.
But if we were pitching this to an investment committee, based on everything we just discussed, here's the trade idea.
An aggressive but plausible trade.
The thesis is simple.
Yeah.
The narrative has structurally changed.
Right.
This is not the old Bancolombia. This is Grupo Cibest, a high ROE platform with a profitable digital bank in Nequi. We think the market has priced the great quarter, but not the sustainability of that 16 to 17% ROE combined with those buybacks.
So the trade would...
A long position in the CIB ADR, but funded by a short position in the Global X MSCI Colombia ETF, ticker COALO.
Okay, so you're isolating the CIB specific story.
Exactly. You short the whole country ETF to hedge out all that macro and geopolitical risk the skeptical analysts are worried about. Currency moves, political noise, you're hedged.
So your bet is purely on CIB's specific catalysts continuing to drive outperformance.
Right. You're betting on the buyback execution and the eventual value unlock from Nequi. CIB has already crushed the CLO ETF over the past year. This trade is a bet that the gap keeps widening as the market is forced to accept this new higher multiple story.
It's a compelling way to bet on the company's execution over the country's volatility.
Indeed. So to quickly recap the three big takeaways for management. First, Breathe. The successful launch and the positive cash flows show they can dominate new ecosystems.
Second, their interest rate risk management is top-notch. The swaps, the shorter tenors, that's going to protect margins when rates fall.
And third, the buyback is real. They are using the capital freed up from the new structure to deliver real returns to shareholders.
Which leaves us with one final provocative thought for you to think about. Management said Nequi will separate and become a standalone company in the second half of 2026.
So if you take Nequi, which is now profitable, growing like crazy and making high-yield loans, and you completely unbundle it from the core bank, what is that sum of the parts really worth? Does that justify a re-rating that blows past today's $63 price and makes that old $42 target look completely obsolete?
That's the real story we'll be tracking. Thank you for joining this deep dive.
Remember, everything we discussed is for informational purposes only. Do your own research before making any investment decisions. We'll see you next time.